Now we are starting with a new segment, and that new segment is given a name as beta of unlevered firm. This is also given a name as beta of asset. That is a new segment, that is the new concept that say we are going to start. Everybody is requested to pay attention. Dear students, we understand that as far as the beta is concerned, CAPM concept is concerned, it is helpful to an investor who is going to make investment in a security. That helps an investor to decide that whether to make investment in the security or not by making calculation of the alpha of the security. Further, we understand that say it also helps an investor to determine the equilibrium price of the security. We understand logically that if alpha is positive, then in that case the investor should buy the security. If alpha is negative, investor should not buy the security. Again, we can make the comparison of the actual price with the equilibrium price to decide, let's say, whether an investment should be made or not. Now, apart from this, now we are going to have understanding of the concept of the beta that is going to be useful even to a corporate. Yes, it is going to helpful to a company to determine what is the rate at which it requires a return from any of the project. I am giving you a certain example like this. Suppose there is a company called ABC Limited, and it is going to undertake an investment in, let us say, automobile sector. Right now ABC Limited is doing business of, let us say, uh, in electronic line, and it is going to undertake a project, let us say that in automobile sector. Just I'm that is providing you a random value. Suppose ABC Limited has currently the required rate of return of 16% from the existing business. Whether the same discounting rate can be applied for discounting the cash flow series for the new line of business? What is your answer? Put your answer in the chat box. Correct answer. We understand that whatever the current required rate of return, that cannot be applied for the purpose of discounting the cash flow series for the new line of business. We understand that the pros and cons of the existing line of the business and the new line of the business are different. That is the reason, say, we should not be applying the same discounting rate for discounting the cash flow series for the new line of business. What we should do then, we should calculate the risk adjusted discounting rate for the new line of business. In order to make the computation of the risk adjusted discounting rate for the new line of business, what we will do, importantly we understand that say we will make the calculation, that is we will take into account details of the proxy firm. We will take into account the details of the proxy firm, and based on that, say we will make the computation of the required rate of return. What does the term proxy firm mean? Proxy firm means a company which is doing similar business in which we are diversifying. We are going to diversify, say, in the new line of business, that is automobile sector. So what happens that say whatever the risk or whatever the opportunities that the new line of the business has is what say currently a company which is doing business in that line of the business must be facing. That is the reason, say, taking into account so the proxy firm as a base, we would like to say make the calculation that say what would be the rate at which we should be discounting the cash flow series for the new line of the business. We understand that say we can make the calculation of the projected cash flow series for the new line of the business, and it will be discounted with risk adjusted discounting rate. How to make that calculation, that is what say we are going to understand. So friends, we understand that say over here in this segment we are going to understand that say from a company point of view, what is the rate at which say we require the return say from the new line of the business. And even if at all a company is expanding its existing business, then what is the rate at which it should require the return for the expansion program. This is what say we are going to understand say in this segment. Let us understand that say how to make the calculation of this. Uh, to make this calculation, we have the concept to be applied is something related to net operating income approach, that is a capital structure theory which we have studied at our second level. I just give you some reminder, so some like the explanation with respect to the net operating income approach. As far as the net operating income approach is concerned, it has say the two separate conclusions. The first conclusion is that, first situation is if at all there are no taxes, and the second is so the tax information is given. In case of no tax, the net operating income approach has a kind of conclusion like this. On x-axis we take the debt financing, and on y-axis we take the cost of capital. So what happens at say when there is an increase in the debt financing, when there is no debt financing, cost of equity and weighted average cost of capital is same. Whenever you are increasing the debt financing in the capital structure, at that time risk for the equity shareholder increases, and risk for the equity shareholder increases in such a way so that the benefit of raising the lower cost of the funds is compensated, and weighted average cost of capital or overall cost of capital is same. This is what we understand is the cost of debt financing, which is going to be lower than cost of equity. When there is an increase in the debt financing, then the risk for the equity shareholder increases. So the cost of equity increases, and it increases in such a way so that the benefit of raising debt financing is compensated, and overall cost of capital or weighted average cost of capital is same as it was otherwise. This is the conclusion that we have studied about the net operating income approach when there is no taxes. Based on this only, we will be having the concept of like the beta of unlevered firm. I am taking help of this question to give you explanation of this like the concept. Do not write anything, let me explain you. X Limited is providing following information. Currently it is doing business of manufacturing of the machine tools. The proportion of the debt financing in the capital structure is 40%, and its equity beta is given to us as 1.25. So this is the current information provided to us. Now it is diversifying into new line of business. So it is entering into new line of the business, that is manufacturing of the mobile phone. The proxy firm means a company which is doing similar business in which we are entering into is NOKIA company. The proportion of the debt financing in the capital structure is 30%. They have 30% of the debt financing in capital structure, and its equity beta is 1.12. Return on the market portfolio is 25%. Risk-free rate of return is 10%. Ex Limited is going to keep 25% debt in capital structure for the new line of the business. Second question, Ex Limited is going to keep 35% debt in capital structure for the new line of business. Calculate a required rate of return for Ex Limited from the new line of business. That is a question. So friends, over here, what happens at say from Ex Limited point of view, the information is given that say it is entering into new line of business. Whatever the existing information which is given to us, it is of no use to us. For the proxy firm we have been given, it has the debt financing of 30%. So let us say that it is having the debt financing of 30% in the capital structure. So taking that say the 30% debt in capital structure, Nokia company will have this as the cost of equity and this as the weighted average cost of capital. As far as the cost of debt is concerned, it is same only, because in that say there is no major effect, because the investors of the debentures are going to get the same return. Now listen carefully what I am going to speak further. What we are going to do, we are going to keep 25% debt in the capital structure. It means that comparatively we are going to keep less debt financing in the capital structure. If at all we are having the less debt financing in the capital structure, then in that case we will be having comparatively lower cost of equity. The cost of equity will be comparatively less, and we are required to make the computation that so what would be the beta of the equity applicable to us. As far as the Nokia company is concerned, Nokia company's equity beta is provided to us as 1.12. Beta of equity for the Nokia company is 1.12. That is provided to us. Now this is what we are required to compute, and with that so the cost of equity and weighted average cost of capital is required to be calculated. This is what we are required to do. In second part of the question, we are going to keep 35% debt, means the proportion of the debt financing is more. If at all the proportion of the debt financing is more, then in that case again the beta of levered equity applicable to us will be more. If at all the beta of the levered equity is more, then with that so the debt financing is more, so the beta of the levered equity will be more, and accordingly the cost of equity will be more. And these things are required to be calculated for Ex Limited, and based on that so we are required to make the calculation for the discounting rate applicable for the new line of the business for both the capital structures. Okay, now how to do it, that is what now I am explaining to you. What to do it, I have explained to you. Now how to make the calculation, let us have understanding. It is required to be found something like this. See, as I have mentioned over here in the heading, it is beta of unlevered firm. The term unlevered stands for no debt financing. So what we will do, dear students, taking into account the beta of the levered equity, that is 1.12, taking into account the proportion of the debt financing in capital structure, we will compute that say what is the beta of unlevered equity. It means that say suppose there is a situation wherein the company has not introduced any debt financing, then how to, that is then in that case what would be the beta of the equity is required to be calculated. This is what's the first thing. Then we are required to make the calculation of beta of the levered equity considering the capital structure which the diversifying firm is going to maintain. I repeat it again. First of all, we'll compute the beta of unlevered equity, that is taking into account the information about the proxy firm capital structure, proxy firm beta of the levered equity, will compute the beta of unlevered equity, means what is the beta of the equity, suppose there is no debt financing, and of course the answer is going to be less than 1.12. Second, taking into account the capital structure that you are going to maintain, will make the calculation of the beta of the levered equity once again. That is what we are required to do. And then we'll make the calculation of the discounting rate. That is cost of equity, cost of debt, weighted average cost of capital. That is what we are required to do in the third step. These are the three steps in which we have to do answer. I am dictating a note to you. Before that, I just want to complete this numerical. With that, you will be better able to understand the note that I am going to dictate. So let us make the calculation of answer and then I am dictating note to you. Estimated is providing the following information wherein current information is given which is of no use. It is diversifying into new line of business, and new line of the business is manufacturing of the mobile phone. Nokia company is a company which is doing that business. The proportion of the debt financing in the capital structure and equity beta is given. The question says that if at all you are going to keep 25% debt in the capital structure, what is the discounting rate applicable for the new line of business? So I'm doing first of all the first part of the question in detail, ignoring the second part. Let us answer the question. Answer for the first question. Calculation of cost of capital for new line of business, comma, if company is going to keep 25% debt in capital structure. In the write down, step number 1, calculation of beta of unlevered equity. Beta of unlevered equity. It means that what is the beta of equity when there is no debt financing? It will be calculated like this. Yes, just I explain you, dear students. There are two formulas that we have. One is a situation of no taxes and another is a situation of tax. When there is no tax, then the beta of unlevered equity or beta of asset is simple weighted average. There is nothing else but it is simple weighted average. We understand that source of finance, weight, beta, weight into beta. There are two sources of finance which like the proxy firm has. It is equity and debt. The proportion of the debt in capital structure is 30%. So the remaining is equity 70%. This is 1.12. This is 0. So 0.7 into 1.12. It is 0.784. This is 0. And this is the way we compute the beta of asset or beta of unlevered equity. So it is 0.784. This is the way we are required to work out the answer. With paragraph right now, if there are no taxes, comma, beta of asset or beta of unlevered equity is calculated using simple weighted average formula. Full stop. Beta of debt is taken as 0, comma, in absence of any information. That is what we understand. Okay. Step number 2, calculation of beta of levered equity applicable to X limited. In bracket I am writing beta of levered equity. Dear students, the term levered stands for you have introduced the debt financing. So again the column number 1 is source of finance. Column number 2 is weight. Third column is beta. Weight into beta. Source of finance is equity and debt. What is the weight? It is 75% and 25%, because 25% debt means 75% is equity. That is what we understand. Again, this is 0, so this will also be 0. Importantly, friends, we understand beta of the asset will be 0.784 in a way that say this is going to remain same for all the companies which are doing that business. So beta of asset or beta of unlevered equity is 0.784. So this will be found as balancing figure 0.784, and accordingly again this will be found as balancing figure 0.784 divided by 0.75. So the answer is 1.04533 or 1.0453. That is the way, so the beta of the levered equity is calculated. So this is the way, say this value is calculated as balancing figure. Okay. Now we'll make the calculation of step number 3, calculation of weighted average cost of capital. In that, we'll make the calculation of work, that is cost of equity, that is working note A, calculation of cost of equity. Cost of equity will be found as RF plus beta into RM minus RF. What is the risk-free rate of return given to us in the question? RF is given as 10%. So we will have the answer like this. 10 plus, what is beta? Beta is 1.0453. What is RM? It is 25. What is RF? It is 10. 10 plus 1.0453 into 15. So 1.0453 into 15, that is 15.68. that is 25.68. That is the way the cost of equity is found. Working out B, calculation of KD. Now regarding the rate of interest at which we can borrow, no information is given. So we assume that we can borrow at a risk-free rate of return. So write down in that, in absence of any information about rate of interest at which funds can be borrowed, comma, we are assuming that it can be borrowed at RF. So for KD, the formula will be, dear students, rate of interest into 1 minus T. What is rate of interest? It is 10. Tax rate information is not given. So we are ignoring tax. So it will be 10%. That is the cost of debt financing. Calculation of weighted average cost of capital. Again, there are two sources of finance. That is equity and debt. Weight or proportion in which the funds have been raised. It is 0.75 and 0.25. Multiplied with the cost of capital. It is 25.68 and it is 10%. Weight into cost, 0.75 into 25.68 is 19.26 and this is 2.5. So it is 21.76. That is the way weighted average or overall cost of capital is calculated. So this is the way the weighted average cost of capital is calculated. 0.75 into 0.75 into 25.68 and 0.25 into 10. That is the way we find answer. So I just repeat the sequence in which we have done answer for the first question. The first question is calculation of the cost of capital for the new line of the business if the company is going to have 25% debt in the capital structure. First of all, taking into account the proxy firm information, we have computed the beta of unlevered equity means beta of the asset is calculated. There are two sources from which the funds have been raised by the proxy firm. For 70% of the equity, the beta is 1.12. So overall beta of the asset is 0.784. Dear students, importantly, when there are no taxes, the beta of the asset is simple weighted average. If tax is there, in that case, what is supposed to be done? That we are going to discuss later on. Step number 2, calculation of the beta of the levered equity, considering the capital structure that say we are going to keep 25% debt in the capital structure, so 75% is equity. Overall beta of the levered equity is 0.784. So this is found as balancing figure 0.784 and based on that, say this is found as balancing figure 1.045. Calculation of the weighted average cost of capital or overall cost of capital. In that, first of all, we compute the cost of equity, RF plus beta into RM minus RF. Cost of debt financing, we assume that we can raise the funds at RF in a way that there is no risk from the investor point of view when they make investment in our debentures. So KD is found. And lastly, simple weighted average, we have computed the weighted average cost of capital. This is the answer of the first part of the question. Second part of the question, if 35% debt in the capital structure for the new line of the business. I request all of you to do answer for the second part of the question on your own and put your answer in the chat box.